tomorrow or Friday, so we might see you there.
Yeah, I'll be around Friday, definitely. Tomorrow, I think afternoon-wise, I should be, yeah.
Okay, cool, good stuff. Okay, so the link is now there, so I'm going to start sharing the link around. Okay, now I'll start sending out on the groups.
Just gonna cut the window quick.
Yeah, go for it. And check out the live event here. Okay. Sorry, Azish, I'm just sharing this link around everywhere.
No worries. Take time.
Okay. I think we're almost. Oh yes, just the LinkedIn group, and then we're good to go. Okay. Okay, so we're already live on our LinkedIn page. That's okay.
Fantastic.
People are hearing our conversation as we're getting ready for this, so that's fine. If you're listening in, hello everyone, and assalamu alaikum. We're going to kick off in just a couple of minutes, but I'm very lucky to be joined here by Zishan, who's the COO of Yielders, who's our newest member of the Kestrl marketplace, which launched just a couple of days ago. So we'll be kicking off in just a couple of minutes, and then you can hear all about Yielders and their offering. So please bear with us whilst we get this party started. Second, just phrasing. Okay. Chat. Okay. You can hear us? Okay, excellent. Hey. Okay, perfect. All right. Assalamu alaikum, everyone. Thank you very much for joining day 2 of Kestrl's Halal Investment Roadshow. Today is all about property. Yesterday, we were talking about equity investments. Day 2, as promised, is all about property. And we're really lucky to be joined here by our partners, Yielders. Yielders, where you can crowd invest into property from as little as £100. So if you haven't already, please do download the Kestrl app and check out our new investment marketplace, where you can check out Yielders and a bunch of other halal investment providers on the marketplace. So just give us a couple more minutes whilst we wait for a few more people to dial in, and then we're going to kick off, inshallah. So thank you. Okay. So, this is probably like the 3rd event we've done together, Zishan, 3rd or 4th?
I think so, yeah. We've started to clock up the hours, haven't we?
Yeah, I think so. I think the first one was probably this time last year, actually. I don't know if you remember that one.
Yeah, I think we'd sort of just got the lockdown, hadn't we? And we were.
Yeah, it was all about how to invest during lockdown.
Yeah.
And Abul from Wahid was there as well.
Yes. Yeah. God, was that really a year ago?
Yeah. Okay. Okay, looking good. All right, so guys, do you mind just dropping us a note if you can hear us okay on YouTube? I've got a bit of a lag, so I can't quite see. So hopefully you can see this one. Okay. It's saying still scheduled. I think some people can hear us and some people can't. Let me see. No, I'm pretty sure we're live. Guys, if you can hear us, please just say hello. Oh. Okay, it's a scheduled. 1 second.
It seems as if the Yielders team were listening on YouTube and said that they could hear us.
Yeah, so YouTube is working and LinkedIn is working. That's interesting. Well, it's gone 5 now. Maybe I just need to hit. Okay, so some people can hear us. So a few questions coming in. Yes, so all of the events, day 1, 2, and 3, including yesterday's, which was day 1, the recordings will be live on our YouTube channel and various social medias as well. But please do stick around for the live event as well, and then you can have your questions answered. So we're just going to kick off in just literally 1 minute, hopefully less than that. It just seems some people can't see us, and it hasn't gone live yet. So I'm just trying to double check. Some people can. Hi, Irfan. Thanks for confirming. Team Yielders can. Okay, perfect. Okay, I think we should be live now for most people. If you still can't hear us, just keep refreshing. If you can't hear me, you can't tell me. Yeah, I can't tell you to refresh. So if you guys are on the channels, you can just keep on refreshing and tell other people to refresh, and then we can kick off. But hello, assalamu alaikum, everyone, and welcome to day 2 of our Halal Investment Roadshow. Today's session is all about property. So at Kestrl, we're really excited to have onboarded investments to our app for the first time. So that started a couple of days ago. Yielders are there as one of our main 3 investment providers who are all entirely Sharia compliant, and they are available to view, compare, and invest directly in, along with all of our other providers. So we're really lucky to be joined by the COO of Yielders, Zishan, who's joined us many times before, is a familiar face here at Kestrl, to talk all about this really interesting, really exciting, and sometimes a little bit complicated asset class. To break that down and to talk about Yielders offering as well. So welcome, Zishan. Would you like to give like a 30-second intro to yourself?
Sure. Assalamu alaikum, everybody. Thank you very much, Kestrl. I really appreciate having us on again in terms of a webinar. Really informative, the last few that we've had, and absolutely fantastic in terms of the work that you guys have been doing specifically with the app. COO and co-founder at Yielders, my name is Zishan Upal. I have been in this position for coming up to 6 years now, which is pretty mind-blowing when I think about it. 6 years of my time that we spent building this, but alhamdulillah. So Yielders was the first FCA regulated Islamic fintech platform in the UK. And effectively, we provide real estate investment opportunities to everybody, wherever you may be in the world, from as little as £100. We've lowered the barriers to entry to real estate investment opportunities, democratizing real estate investment opportunities, and really just open up the playing field to everybody to allow them to be involved in a traditionally inaccessible asset class. If you think about real estate, you generally have to have a large deposit. You generally have to then go to a bank to get a mortgage of some sort. So what we decided to do was very much take the essence of real estate investing, simplify it via the use of our platform, and allow people from as little as £100 to get involved in real estate investing. Now, we're not offering life-changing returns that, if you invest £100, you can quit your job and live off the returns from Yielders, but it is a way to earn residual income over a period of time and grow wealth, which I think is key, specifically in the fintech and Islamic finance space.
Oh, absolutely. And we'll be going into that in a lot more detail, and we can take a look at some of the opportunities which are, I think, available and live right now at Yielders too later on in this. So there's a few things which I'd love to cover within this session. I broadly want to break them down into a few areas. So number 1, just talking about property as an asset class and why it's been so popular amongst Muslims in general. Number 2, talking about some of the benefits and also some of the downsides of maybe property as well. And then finally, talking about how Yielders access some of those and has made it a lot simpler and easier, and how people can actually get involved and invest in some of the things which are available on Yielders today. We'll then be opening it up to Q&A, and some of you have been kind enough to send in questions already. If you're feeling a bit shy and you don't want to put them on the YouTube video or on LinkedIn, just feel free to DM us on LinkedIn or on Instagram, or you can email us at info@kestrl.co.uk, and we'll read them out here anonymously. Okay, perfect. So Zishan, are you ready?
I
First
am. Get started.
So property has always, as an asset class for as long as I can remember, I think been really attractive to Muslims in particular. It's definitely up there with gold, in terms of things which I think many of our parents' generation seem as like the go-to asset class to invest in. Why is that? Why has it been so popular among Muslims in particular?
I think it boils down to looking at the historical nature of real estate. So if you look over, say, the last 30, 40 years, there has been a steady increase of real estate in terms of value of that going on in an upwards trajectory. Obviously, we've got miscellaneous events such as the 2008 financial crisis where there was a slight dip. But if you look at sort of a macro view, a zoned out view of real estate over the last 30 or 40 years, we've seen a general increase in the capital appreciation of bricks and mortar. And I think that the simplicity of it really is what attracted people initially. It's always seen as a safe investment opportunity. You know, buying your own home and then looking to further invest in real estate is easy to a certain extent in terms of if you know what you're doing. But also, I think generally looking at the upward trends of investment, it's less volatile as well. As I said, you know, you've got something like the 2008 financial crisis where, a significant decrease in macroeconomic conditions caused a fall in property values. But generally, over a long period of time, you see increased valuations, increased capital appreciation across an asset class, which, you know, is easy to understand from a perspective. It's bricks and mortar. You know, it's not a complex financial instrument per se that you've got to be watching financial charts for, understanding what financial implications there are for changes in different financial instruments. It's very much, you know, bricks and mortar, easy to understand. And I think the first thing that people generally think about, if we think of older generations, specifically in the Southeast and Eastern Asian communities, which predominantly are the largest population of Muslims in this country, it's people coming to this country having, you know, migrated generally, and looking at an asset class that again, you know, you live in a house, you end up wanting to own the house rather than having to spend money on rental income for a prolonged time. So I think the two key elements really are simplicity and the general upward trend of appreciation within the real estate market in this country.
Absolutely. I mean, at Kestrl, we noticed perhaps a third thing as well, in that when it comes to building up a portfolio, typically something like, you know, straight shares or equity might be considered riskier than something with a relatively fixed return like a bond. Bonds or other interest-based type assets, which aren't often available to Muslims because of our beliefs, wanting to avoid interest, whereas property can sort of represent a good alternative to that, offering quite a good fixed return, a relatively low risk compared to some of the other asset classes out there.
Agreed. And there is an equity element of real estate, right? You know, Yielders is completely equity based, so there is no grey area with you, if you will. You know, other financial products, you know, there may be some interest bearing element to it somewhere down the line, a contractual relationship with a financial institution or something that does muddy the waters. Whereas with property, it's very straightforward. If you've got, you know, it's a cash on cash transaction, you can purchase a property outright for the funds that you have in a bank account, for example, versus, you know, investing in a tool or a financial product that you don't actually know what the underlying, as far as you can tell, the underlying element may be halal, but, you know, who really knows what Sharia compliant products may potentially include an interest-based product somewhere down the line.
Yeah, no, absolutely. Okay, cool. So going straight on to the next one, and some of you have asked this one as well. So what are the key benefits to investing in property as opposed to some of the other asset classes, perhaps?
I think this actually boils down to the three elements that we consider our offering to be Sharia based rather than Sharia compliant. So we took three very simple elements of Islamic finance and brought them to the effectively center of our business, and that's what we've decided to, you know, build upon. Rather than taking a complex financial structure and making it Sharia compliant, we from the very beginning built something Sharia based off of three core principles. These three principles being no interest, so no riba associated with any of our products. Everything is 100% equity based. investing in an asset class which is not volatile in nature. So alluding back to the conversation that we've just had of having a general upward trajectory trend of real estate over the last 30 or 40 years versus something like the FTSE, which on a daily basis is generally quite volatile. And the third one being investing in an asset class which is simple in nature and easy to understand for people. These three core principles are the element of why we've created a Sharia-based investment. And I think that particularly leads to people wanting to invest in an asset class, but also, aside from taking yield as outside of the picture, real estate is an income-generating asset. There is always going to be a demand issue for real estate. People need somewhere to live. The people that are unable to obviously afford their own home, rent homes, which obviously produces an income for landlords. But not only that, there is also a significant housing shortage throughout the UK, predominantly in London. And for us, an asset class which we're able to think of a strong covenant associated with the income that we're able to generate. So, having tier one contracts with local housing authorities, which are effectively backed by government contracts, and other tier one providers, thinking of social care and housing for the more vulnerable people of society, we've over a period of time built relationships with these tier one providers. We're able to provide that steady income and have long-term lease agreements that are producing a consistent income away from void periods. Now, this has been a process that we've learned. There have been a number of assets that we've privately let with AST contracts, so private contracts between us and individuals. There are the risk of void periods throughout that and impact on returns. So having learned and developed that over a period of time, we've now come to a place where we're able to just engage with tier one providers, and that constant supply of income against the assets that we own has held us in good stead, really.
Amazing. And I love that, the idea that there's always going to be demand for houses, which means that, even though property prices might fluctuate, it's not like if you were to invest in property, you're going to lose it all in the blink of an eye, unless, you're investing in a single property, which, and something were to happen to that. It's not like that the value of that investment is ever going to depreciate entirely to zero.
Yeah. I think the effect of element of you're investing into a tangible asset-backed asset class. It's there. It's there for everybody to see. You're not investing in a bond like you've touched upon, which is a certificate or almost shares in a company, which to a certain extent is not tangible. It's not visible. You can't go and visit it. You can't say, right, this is the house that I own, or this is the element or part of the house that I own. So I think the tangible nature, asset-backed, it is real, and I think people are able to align to that, especially when it comes to investing. And you think there is a complete shift and a change in rhetoric, I think, over this last year when it comes to investing. Over the lockdown period, people have had a lot more time to think about investment opportunities and look into growing their wealth, and I think that a cornerstone of that real estate investment is key to that. Obviously, diversifying your portfolio and looking at other products is also key. But I think you think of any people that have grown their fund, grown their wealth, and looking to pass on that generational wealth, always have an element of a real estate portfolio.
No, absolutely. And an interesting point that you brought up again, as well as talking about the returns and the yields for that specifically. So a question that's come in from someone who wishes to remain anonymous. I've heard that the general return that you can see on a London property is about 3 to 5%, whereas up north that you can even get between 7, sometimes 10, 11%. Would you say that is accurate? And what's the difference between these and commercial properties? So there's a lot to break down there. Do you want to have a go at that?
Sure. So I think we're able to even apply this to our own platform. So we've got assets that are based throughout the country. It's not ever really concentrated in one area. Wherever we're able to find a deal that passes our due diligence and the thresholds that we're looking to achieve is what we would list on the platform. So given the first part of that question in London versus the rest of the UK, the reason behind the yields being lower in London are ultimately down to the value of the properties. So the assets that are much higher in value, the yield that you're able to achieve for them aren't as good as, say, for an example, an asset further north, where sort of Midlands and above, we generally tend to see the double digit gross returns that this question specifically referred to. So I think the first element is you've got to think about London as tier one in terms of real estate. But what London does have that other elements of the country don't have in terms of longevity is capital appreciation. So you would not see the rate of capital appreciation, for example, in a place further out, Midlands and above, versus what you would see in London over that same period of time. So there are those two elements that you really have to factor in when looking at real estate investment. Are you looking on it from a yield perspective? So are you looking for a continuous income, or are you holding this asset for a period of time to realize any capital appreciation which may occur over a period of time?
So that's a really interesting dichotomy there. So London property rent might be less, so year on year what you're getting there, but the value of the property increasing over time might be a lot higher than a property, say, up north, whereas a property up north, the rent may be higher overall, but the value of the property may not increase as quickly as London at the moment.
Okay. Exactly. And I'd say, the careful element of this is to think about the value of the rent against the value of the property, because that is determined, what the yield is determined by. Now, you may see larger, for example, in a one-bedroom flat in London, £1,500 a month it may be charged, and in the Midlands you could get away with £750, for example. But even though you may have the increased amount of rental income available to you, the value of the property is that much higher that it affects the yield. So the yield is effectively a simple calculation of the value of the rental income divided by the value of the property. So, for the example I gave, £1,500 a month over a 12-month period divided by whatever the value of the property is. So, it's all relative. You may have a higher income, but the amount of the cost of the property effectively diminishes the yield, versus you may have a smaller amount of rental income on a monthly basis from a property up north, but the value of the property is that much smaller. The yield is greater effectively.
Yeah, no, absolutely. So we've talked about the upsides of property. It seems great. It seems very attractive. What about some of the downsides to it?
Plenty of downsides. I mean, as with anything, we're a fully financially regulated business, and with anything, we provide risk warnings across all of our investment opportunities. No point are we saying we're guaranteeing returns. First of all, that would be unhalal. It wouldn't be in line with Sharia. But also, we are under strict due diligence from the FCA. They are always monitoring how we decide to market our product to people. And one thing that they're very, very hot on is the sort of language that you use, not to provide too much enticing information. We're not ever promising these fantastic returns that are going to change your life. It's very vanilla language to ensure the safety and security of our investment to our investors. So that is a hugely pertinent point. Some of the downsides that are associated with real estate investing, and I think this is the element that we do really well, is to try and take away some of the heavy lifting associated with real estate investing. So with our platform, you're able to interact with it and invest in a very, very hands-off manner. So you're able to effectively be a buy-to-let landlord without any of the hassle associated with it. Now, the hassle is, a tenant calling you at 3 o'clock in the morning because a pipe has burst. We have managing agents in place, and we handle any of the issues that arise from that. Other elements, void periods, which I've already touched upon. So if you've got privately let assets, flats, buildings, whatever it may be, there is always the risk that your tenant may not pay you. There are obviously laws and everything, protocols that you have to follow should that happen. We obviously have had a pretty good view of that, specifically over the COVID year, where a lot of power was given back to tenants, given the situation that everybody was in terms of furlough, people losing their jobs. The government made it such that protect people in their homes, which obviously I think is something that was required at the time. But that is a massive risk associated with specifically private buy-to-let landlords and AST contracts. People either disrespecting the space that they live in, not treating it with the level of respect that you would anticipate. So increased costs associated with whatever potential works that are associated with that, vandalism, and then people just generally not paying rent. Now, if that happens, you're effectively stuck with an asset that you own that is not producing the income that you would expect, which is obviously a negative, specifically if there is any financing or lending against it. You as the owner would then be in trouble. For us, it's a little bit different, completely equity based. So if we're not able to produce an income, what effectively just happens is we're not passing that income on to our investors. However, the ownership and the underlying equity nature of the property is still owned. It's not losing any value. we're just not producing an income against it. So the risk is mitigated to a certain extent with the business processes that we have in place. However, that is the inherent risk with real estate investing, that you're not going to get the income that you anticipate. Another risk being capital depreciation. So we've talked about the positive element, but for example, if we were to have purchased some of these properties that we own in 2007, we then entered a financial crisis in 2008 where there's a macro depreciation across the board. We would be effectively sat on negative equity for our investors. That is a position where you have bought the asset for more than market value, it is depreciated in value, and the asset is actually worth less than what you paid for it. Now, again, the business model that we've created is able to mitigate against that risk quite well. We're never under any pressure from anybody to sell the property. We as yielders, as investors, are owners of the property. Whereas if you've got a bank loan or a mortgage and there is a depreciation and you're unable to make those payments, you're at the mercy of the bank. With us, if we're not receiving any income, there is a depreciation in the market, we're able to hold that asset for as long as we need to ensure that the market recovers to prevent any capital losses for our investors. So I think those two key elements are very pertinent in our business model to mitigate these risks. There are risks. There is risks with any financial investment that you're ever going to make. The key that we try to differentiate ourselves is mitigation against that risk. And I think with the equity element of what we've got in place, the legal structures that we've got in place do protect our investors as much as possible.
No, absolutely. And I think this is a really good time to come on to your offering specifically. So what I'd love to do is to share my screen, if it's going to let me. Yeah. Okay. So that's not what I'm sorry, Zishan. Do you mind trying to share your screen if that's
Sure.
if I let you do that?
Screen. Unfortunately, I loaded this on Safari and it says Safari does not support screen sharing.
That's exactly what's happening to me right now. But it's okay. I'll figure it out as we're talking. And if you want to go into, so I suppose the question is, we talked about some of the downsides. You've already talked about how yielders mitigate some of those downsides already. But quite a good question to start this off is Aidan has asked specifically, is Yielders a REIT? A REIT is a real estate investment trust, and does it offer REIT investments? So this might be a good idea, a good time to break down exactly how does the process work with Yielders. Like, what happens if, say, I invest £100 into a property which is live right now with Yielders? What am I actually getting out of it, and how does it work?
Sure. So just specifically on that question, we're not a REIT, because a REIT, the difference between a REIT, very similar, but the difference between us and a REIT is a REIT is publicly listed and you're able to trade in and out of that. We have got something very similar, but it's not listed. It is standalone via our own platform. Effectively, the way that our process works is each of the assets that we decide to purchase. So this is after a long due diligence process, and we get hundreds of deals posted to us on a weekly basis, and very few of them make them through this process, purely down to the fact that the thresholds that we've set to ensure that we're providing a product that's not only competitive, but also does exactly what it says on the tin. We've ensured that the thresholds are very high, and only the very best of asset classes do make it through this process for us to be able to list. Now, when the investment committee has made a decision on an asset that we're going to acquire, we open a specific SPV, which is a special purpose vehicle. These nothing but a new limited company. Each of the assets are acquired within this limited company. So we go out and we cash purchase assets, and the owner of these assets is SPVY 000, whatever number we're up to at this moment in time. Now, we have got a network of top yielders. So these are high net worth individuals, ultra high net worth individuals who are our anchor investors. We use the funds that we have on account from them to purchase the assets that we have decided are suitable for the platform. So using our anchor investors, we will go and purchase these assets. These assets are at this moment owned. The due diligence process is such that we are purchasing assets which are already income generating with a tier 1 tenant or agent in place. So they are an income generating asset from the moment that we acquire them. We purchase these assets in the SPV using top yielders money, and they are income generating. So the first month, all of the rental income is redistributed to the top yielders who helped us purchase it. At this moment in time, we then decide to list the asset onto the retail platform, which is what you and everybody else would see when they list, when they go visit www.yielders.co.uk. On there, you will see a number of offerings of assets that we have available at any given time. What we have is something I think that we've described before, a mix between Zoopla and an online bank account. What we've decided to do with the platform is provide a transparent view of everything associated with any of these deals. So there is a financial summary, a profit and loss with each of these, showing exactly what the acquisition costs are, what you're going to earn, what we've earned, a complete transparent view effectively of the business. There's two key legal documents, so the information memorandum and articles of association. These are effectively the business plan and the governance of the asset. So from a very stands-off perspective, once you've read all these documents, you effectively know from the point that you invest to the point that we decide what the investment term is, you're able to invest what you could potentially earn and what your expectations of an exit are. We have an investment calculator as well, so you're able to decide if I want to invest £5,000, £10,000, whatever that amount may be. You're able to calculate what your projected returns would look like over the period of time that you're looking to invest. Now, once you've done this, you're able to scroll through some pictures, very similar to Zoopla, so you get an idea of what the property looks like, where it's located, some key information and statistics about it. You then literally, all you have to do is quite literally type in the amount that you want to invest, click invest a couple of times. It gives you a complete breakdown of what your investment amount is, how much stamp duty you're going to pay, with the number of shares that you're going to own effectively. The moment that you press invest, that is it. You have effectively become a shareholder within the special purpose vehicle, the limited company that we have set up, and you own shares to the value of the amount that you have invested in. So we issue 100,000 shares with each of the assets that we list. So for example, if it's a £100,000 property, you invest £5,000, you would own 5,000 shares associated with that property. On a monthly basis from there on in, you on the first of every month, so we've paid a dividend out to our investors on the first of every month for, I think, 65 months now and counting, alhamdulillah, without ever failing on that. So, every single month you will receive an email on the first of every month to say you have now got rental income. And that effectively is your process with us sorted. So you are a shareholder in a limited company who own the asset. So you effectively own shares in an asset which is producing an income. At the end of that investment term, so we have pre-described investment terms, generally 5 years. 5 years allows for enough time to hit potential projected capital appreciation values that we've calculated. At the end of the 5-year term, we revalue the asset. You then vote on the decision to sell the asset for the valuation that we have instructed. We then go out to the open market to achieve an open market sale. If we're unable to do that, then there are a number of different options that we're able to explore in terms of exit for our investors. But effectively, that is a life cycle of the investment.
So sorry to interrupt, but how many times have you done the sale of a property at the end of it so far?
We are through 4 now. Life cycle investments. So the ones that we first started off back in 2016 were generally 3-year terms as we were testing the market. The first asset that we actually managed to exit was in Gravesend, Kent, so just outside of London. We had originally projected a 35% net return over a 3-year period. We actually achieved a 55% net return and that was executed and redistributed out to our investors. Now, this is, again, aligned to the ethos of the business from a perspective of not going out and shouting about fantastic gross returns that we're not able to achieve. We provide conservative net returns. So the difference between gross and net, effectively being gross does not take into account all the fees, costs, and administration associated with it, versus the net amount is, it is the amount that you're going to achieve because we've netted out costs, fees, taxes, etc. So we were able to achieve a 55% net return over a 3-year period, which, if you're able to find me a financial product that does that, please let me know because I'll invest in it myself. So that was one example of something that we were able to overachieve on. And that is, for us, the element of the business that I think we're most proud of. We don't want to sell you something at the very beginning that, this fantastic opportunity. We'd rather give you a conservative estimate and overachieve. Give that confidence to people that, we are doing exactly what we set out to do. On the flip side, there is another asset which I think we listed 6 or 7 months after the Gravesend one. It was in Milton Keynes. The end of the investment term actually came slap bang in the middle of COVID last year. So I think it was April that we were due to sell it. We had the asset valued at that moment in time. There was a slight depreciation in the market at that time. So the valuation that we received actually was due to lose people some capital. So what we decided to do, and again, this is the flexibility that's available to us. We're under no obligation at that point to sell. We put all of that information to the investors. They made the decision at that point that they don't want to sell. So we reapplied the lease agreement for another year, allowed for people to continue to earn rental income for another year. And now actually we have begun the sale process for that. So we're having the asset revalued now at a point in time where macroeconomic conditions are a lot better, and actually we'll be able to dispose of the asset and prevent any capital loss for our investors.
So, I mean, I think that's a huge testament to your values and really putting the customer first. In that, in both scenarios, you didn't have to, go above and beyond. First of all, you didn't have to, provide them with the additional amount that you got on the investment, and then secondly, waiting and actually making sure that you could get them that what was due to them outside of the COVID period.
Precisely.
I think that's great, amazing. So just to recap and just make sure that everyone's understood the process properly. Essentially, you guys are sourcing properties around the country, sometimes in the Midlands, sometimes in the Greater London area. You'll purchase those properties. You'll put them up for sale within your platform. People can then invest in those properties and look to, when they invest, essentially own a proportion of the property itself. If there's a property worth 100K, someone can invest £1,000 and they will own 1% of that property. That property will be live on the platform, and it will generate rent for a certain amount of time, by which if someone owns 1%, they will earn 1% of the rent, which is gained on a monthly basis. And then when you sell that property, in generally on Yielders, about 2 to 5 years time, right? When the property is turned over.
3 to 5 years, yeah.
3 to 5 years, yeah. When you sell it, then you will gain, in this case, 1% of whatever the sale value of the property is at that point in time. And that's pretty much how it works. And Yielders is taking care of all of the headache of putting the tenants into the properties and managing them. A lot of the downsides that we talked about earlier on are kind of sorted within this process. So it's really nice, really simple in checking that out. So please do. They've got a property which is live right now. So if you have the Kestrl app, do check it out, and you can check out Yielders. Sign up for them directly through the marketplace. So yeah, do check that out. So I've worked out how to share my screen, Zishan, but the one problem of doing that is that I'll have to close this down and restart it. So I don't know if we want to do that in order to do that. So I think it's okay. I think we described it fairly well. But I think we can move on to the next question here, which is an interesting one. So this is from Nadia. She says, I already have a property with a mortgage. How can I buy another one without a mortgage? So this is an interesting one. How can she avoid debt into getting into and buying a whole another property?
Sure. Ultimately, the bottom line being is have enough money to purchase a property outright. Now, in order to do that, I think, again, I go back to the generational element of this and our parents having come over here, me being first generation born and bred within this country. I think a lot of people came over to this country with a view of purchasing property and wanting to have a solid home and available to them. Doubling up then on a mortgage, a potential buy-to-let mortgage, obviously, there are elements of that you can explore. Obviously, interest bearing for profitability is something that we as Muslims tend to not partake in. Obviously, everyone's choice is their own. But I think that the generational element that I was speaking of specifically, me growing up as a kid, it was always about getting a good job, save. Saving used to be the hot topic for everybody of that previous generation. Now, I think what has changed for our generation is investing. Now, being able to grow your wealth residually to allow for certain things like purchasing a property outright. With all the will in the world, I don't think you're going to spend a lot of time, a number of years, saving a lot of money to be able to purchase. If you're thinking about even saving, say, 25% of your paycheck, being able to save that strictly and ensure that it's there, it's going to take a very long time for you to be able to get to a point where you're able to actually purchase a property. And I'm thinking of properties and no smaller than 100K and above. It's going to take people generally a lot of time to be able to save for that. So, my viewpoint would be, from a very risk-based approach, of course, investing to be able to residually grow your wealth at a lot faster rate than what savings are going to be able to allow for. Now, by doing so, the time that you may have the lump sum of cash available to you to be able to therefore purchase a second property outright is probably reduced quite significantly versus the years that you may take to just generally save to be able to purchase something at the same amount. So I think a combination of good financial literacy to understand, a risk-based approach to what you're investing in, allowing for that residual income to build, but also at the same time saving a portion of your income as well to create that wealth to then go and purchase a property outright, would be my suggestion in terms of buying another without a mortgage.
I mean, no, absolutely. And I think the bottom line is that ultimately, when it comes to purchasing a property outright, there is a big capital barrier involved there, and yielders can really help you with that. In that, you don't need to save up to 100k, 200k, 300k. You can invest from as little as £100 or larger than that. So something which is a lot more affordable.
And the pertinent point of this as well is the diversification element. You can actually own a portion of a number of different properties right across the country and earn rental income all from them, versus building your own equity-based property portfolio, having to save and invest to increase your wealth to 100 grand at a time to go and purchase properties, versus you could then invest half of that amount in a number of different properties and be earning rental income throughout that period. So Yielders really gives you the opportunity to be able to diversify a real estate investment portfolio, have none of the hassle associated with it, but earn from it as if you were a landlord owning multiple properties throughout the country.
So that's a question that's come in from someone actually. Is it better to invest in multiple properties over a single property? So perhaps if they have a pot of money to invest, could they go on the Yielders platform and invest in a number of them? And is that something that Yielders can do specifically for them, and that they can suggest, how to break them up or something like that? Or is it for them to make their own choice?
Yeah, so I think, again, our Financial Conduct Authority permissions allow for us to create and present deals. We're not financial advisors. So, you're not going to get someone at the end of the line to say, oh, we think you should invest in this, this, and this. Of course, we've been doing this for a long time and we know exactly what works. So I'm able to sit here, being a regulated entity in the business, and say to you, diversification in your portfolio is key. Having de-risking yourself further by having portions of your savings and investment funds in multiple different assets is only going to benefit you in terms of de-risking that further. So, for example, if you decide to concentrate all your risk into one particular asset and, God forbid, whatever happens, we have a void period or we have to distress sell, whatever it may be, all of your funds are tied up into that, versus if you have that diversification and you spread your investment across a number of different assets, you're earning multiple different returns, but you've also de-risked your portfolio right across the board. So if there is an example in one of the assets where we have a distress sale or there's a void period, it's not impacted the rest of your income. It's only a portion of it that's going to have an issue with it. So I would say, again, the ability for yielders to allow that diversification, the ease of use, and investment across a multiple different assets is beneficial for everybody, really.
Absolutely. So an interesting question that's come in, I think it's a very important one. So this is another question from Aiden. So Aiden is an accountant by trade, so it's coming in hot with the tax questions. So would the returns from yielders be taxed as dividends or as rental income / CGT, which is capital gains tax? Is there somewhere one can find the financial position of the entire business and calculate ratios?
So again, the way that we've set up each of the assets is a standalone limited company. So each of the assets has its own accountancy and effectively is a business within itself. So it is subject to corporation tax. So that's the flat rate 19% that we have at the moment. So we tax all of the income at source. And then what is distributed out to investors is a dividend. So there's two ways to look at it. If you're investing via a limited company, which is the most tax efficient way to do so, you effectively get paid that income, which has already been taxed in a corporation, as a dividend into your own company, and it will not be taxed again because it has already been corporation taxed once. Versus investing as an individual, each individual in this country has a £2,000 tax-free allowance. I think it's still £2,000. It is always changing. The government loves to mess with our potential tax benefits, but I believe it's still £2,000. as a dividend, you would have to have invested over £50,000 at a 5% rate to have breached that £2,000 dividend allowance. So it is a dividend, and then obviously upon disposal of the assets, it would then be subject to capital gains, dependent on if there was an increase in the value of your shares at the end of the investment term.
Okay.
So it's all taxed at source, and then any tax that you are personally liable for is dependent on your personal tax circumstances.
Okay, cool. Aidan, I hope that that answered the question, but please shout if there's anything else there. But I think that was pretty sufficient. An interesting question that's coming from a few people. So this one's from LinkedIn. Mohammed Rahmani, Assalamu alaikum, thanks for joining. If someone had to pull out of an investment early and they choose to sell their share using the Yielders Marketplace platform, is the share sold at the price they bought it at? Or could the share price fluctuate? So this is all about early exits. Is that possible? How liquid is the investment itself?
Yeah, so we have got a fully automated secondary market. Again, something which we were first in terms of the fintech space to be able to create something that's completely automated in that space. It is very liquid, and the only reason I can say that is every single asset that we've ever placed on the secondary market has sold out within the given month that we've listed it. So, 6 years worth of transactions on the secondary market, and it is liquid from that perspective. Now, ultimately, you are the shareholder, so you make a decision of what you want to list the shares that you're looking to sell at. Our recommendation is always to sell for the nominal value that you purchased at. So you forego any capital appreciation if it's midterm. The reason we say that is, if you want your capital back and you want it back quickly, the likelihood of people purchasing the shares for the price that you've purchased them at is a lot higher than you having to then revalue the asset, which is, again, in line with the information memorandum, the legal document. You would have to create a valuation report yourself, get some RICS appointed surveyor to go and value the property to prove that there's been a capital appreciation within that period of time that you want to divest in. Come back to us, and then we would list your shares for the value that you decide to. But what you have to obviously be wary of at that time is, are people going to come and purchase and provide the liquidity versus having the nominal share value, which is the price that you bought in at, allowing you to have a much simpler and a much smoother exit. Up until now, no one has voiced and executed on a mid-term valuation. Anyone that has sold in the market has sold for the nominal value that they purchased at, and it has worked, as I mentioned, very well. The liquidity is there for everybody to be able to exit if required.
Okay, excellent. So that covers a few of the questions on LinkedIn now. I was wondering, this is a question from someone who was a bit more of an atypical investor, I think, but you'd classify them as a high net worth or sophisticated investor. I know that Yielders makes that available as well for high net investors. Would you like to talk about your high net worth investor program as well here?
Yeah. So what effectively the top yielder program, as we call it, is high net worth, ultra net worths that you have to qualify for. So it's a slightly more stringent due diligence process, of course, because ultimately more money to be able to invest, we need to make sure that you're able to handle that, again, from a safety and security perspective, and putting our investors' needs and wants at the forefront of everything that we do. So the top yielder program effectively is the pre-funding element, which I've touched upon. So you get first refusal and first access to all of the deals as soon as they are approved for the investment committee. We have an ongoing monthly communication with all of our high net worths to say, right, this is the pipeline of assets that we have approved and will be coming to the platform in any given time. Now, what we have devised for top yielders is pre-funding. We call it pre-funding, but the product for me is, in essence, quite a liquid savings account. Rather than it being an interest-bearing savings account, it's a rental income-bearing savings account. So, for example, our high net worths will place anywhere between £50,000 with us up to £1 million with us, whatever the value of their finances may be. And what they will say to us, we will present them opportunities, and effectively they will use their funds to anchor invest these properties. Now, what they get as a benefit from that is first refusal on the property, so they get access to this before anybody else does. They will get, as I've mentioned already, the first month of rental income on the entire portion. So if we're purchasing a £100,000 asset, we've got one high net worth investor at £100,000, they will get the entire month's first rental income. Prior to us listing the asset live onto the retail platform, that investor, high net worth, is able to hold a 25% share of their holding for the entire investment term. Now, what that will do is the moment that we list the asset on the platform, within that given month, generally we sell out of all of our assets within 1 or 2 month period. They will have 75% of their capital returned to them. 25% will be held on the platform, and they will earn for the next 5 years on that portion. And that capital is paid back to them. They've had rental income paid back to them within that first month, and then they're ready to redeploy that £75,000 in the next asset. So that £75,000 will get the next month's rental income from the new asset. They will earn all of that, and then subsequently, effectively, they will then be able to hold 25% in that asset, and so on and so forth, until that original £100,000 is divested across 4, maybe 5 assets that they've earned an entire rental income for the first portion, and then their capital is deployed, diversified across a number of assets. They're earning rental income for, and then they can obviously look to potentially sell on the secondary market if they need to lay their capital back, or that 75% of funds that is returned to them, they have the option of drawing that down and using that as they wish. So that's the savings account element that I think that we
cool.
tried to touch upon.
And
again, it's not groundbreaking, but it's for these portion of funds. High net worths, ultra high net worths have clearly huge amounts of money that they've got stored away in bank accounts, and it's a product for Muslims, right? You're not going to draw interest down on your bank account, so place it with potential with yielders and earn an income on it in a halal way, but also quite liquid for you to have that capital back should you need to use it.
And what is the minimum amount to become a top yielder?
We always advertise it as £50,000. However, we're always looking for new top yielders. We understand that £50,000 is a lot. We have accepted £25,000 previously, but it depends on your own personal circumstances. We will look at each person individually, have that one-to-one relationship with all of our top yielders because it's required, and make an informed decision as to whether or not we would allow for a lesser amount than £50,000.
Okay, excellent. So we're coming up to the last 10 minutes now, and there's quite a few questions that I would like to get through in that time. So there's another question here from Nadia, which is talking about how does yielders actually make money through this process? Is it on the property management fee, or are there other service fees there too?
Yes. So we've got a very simple fee structure. We charge 2.5% on the fund amount. So if it's £100,000 property, we will list the property for £102,500 effectively. So our fee is wrapped up into the total amount of the asset. Again, that is clearly visible and transparent to everybody in the profit and loss document that's associated with each and every one of the assets we list. We charge a 10% management fee, which is deducted at source of the rental income. So the net returns that you see have already factored that in. And then we charge a 15% profit share. So our actual largest potential revenue is pegged to the asset. Now, the reason we've done that is to ensure that we are providing as much profit and as much return to our investors, and that way our investors win, we win at exactly the same time. The other two fees really are just to cover business and operational costs, and any actual profit that's driven from the business is done so on an exit.
Okay, perfect. So if you have any other questions, please do just keep on dropping them into the comments. But one question here, it's quite an interesting one, Zishan, which is how does the Kestrl and Yielders partnership look to progress in the future? The savings account feature seems quite interesting. Could that be linked with Kestrl's upcoming savings account features? I think it's entirely open. We can't specifically confirm nor deny that thing, but I think it is a very interesting area for Muslims to benefit from when we're looking at alternatives to interest. It's not just beneficial to Muslims; non-Muslims are looking for something which is better than the abysmal returns that conventional interest-based savings accounts are giving them at the moment. So more and more people are looking to turn to equity returns, property being one of the safer equity things out there which you can look to get a return on. So I think the future is bright, and inshallah stick around. Maybe. So Zishan, I don't know if you want.
No, I completely agree. I think you guys have done absolute wonders in terms of what you're doing at the moment, and inshallah may that be a long and fruitful path for you.
Thank you.
partnering with you guys is obviously there's a lot of alignment that we do have. Really appreciate obviously opportunities like this one, and I think there are no boundaries to what could potentially happen in the future, and we're always innovating, looking for new types of products, and thinking of how best to be able to further acquire customers, acquire investors. So I definitely think there's a long-term strategic slant to this relationship.
Amazing. Okay, thank you. So another question here. Someone doesn't want their name read out. That's cool. So can you talk about the difference between residential and commercial properties? And the return on commercials, why does it tend to be higher than residentials? Is yielders interested in going into commercial properties, or do they have that available already?
Yeah. So we have, I think I touched upon the Gravesend asset.
Yeah.
That was actually a split commercial residential deal, our first ever one, which was an interesting concept. As I said, I think we get, not an exaggeration, but hundreds of potential opportunities thrown at us on a weekly basis, and it is very much a process that we follow to align these deals to our thresholds and what we need to be able to provide in terms of covenants, governance, and returns to our investors. They're the three most pertinent elements of our due diligence process. So are we open to commercial properties? Of course. There is actually something that within the next 6 to 8 weeks up near Leeds we're listing, which is a split commercial and residential. So it's definitely something that we're open to. I think obviously the covenants that you do get with commercial tenants is stronger, dependent on what the underlying tenant is. We obviously have limitations to that. The halal nature of our platform, we'd obviously have to avoid gambling, potential tenants and alcohol tenants, these sorts of things. So there are limitations, but it's definitely something that we consider. We do look at. I think given what's happened over this last year, specifically, the commercial market is something which is a hot topic on a macro level. Are people going to start going back to work? Our office space is going to be voided. The high street is dying. We've all been hearing that for a number of years. So it's really us factoring and looking at the risk associated with each of these opportunities. And if a good viable commercial opportunity does come across us, then we wouldn't turn it down effectively. But generally speaking, the product is residential product because we have these now long-standing relationships with providers, which also align to our ESG element of our business. So economic and social good investing, looking at things like social housing, helping asylum seekers be housed, these sorts of things, which I think really help promote that element of our business, which I think is very aligned to the halal and ethical nature of what we do as well.
Okay, amazing. And a really pertinent question as well for many of our users. Can I invest in a yielder's property if I'm outside of the UK?
Yes, alhamdulillah, we have set up our process to allow from investment all over the world. I think we now have hit 50 countries where we investors from, so all over the world. You do obviously have to pass the relevant due diligence questionnaires and proof of ID, proof of funds, these sorts of things, because we are a fully regulated entity. Very, very much a streamlined process in terms of onboarding. You're able to create a profile on our platform within minutes. So we have really looked at that. We are a financial product at the end of the day, so you have to have certain elements in terms of proof of IDs and confirmation of addresses, these sorts of things. But yeah, we accept investment from all over the world, and very proudly so.
Amazing. Okay, so that's a big differentiator, I think, among some of the other offerings out there. So that's huge. Okay, perfect. So I think that actually covers up a bunch of the questions there. So just a quick question from me personally, Zishan. Where could I or anyone else go if they wanted to learn more about property investing or investing in general?
Sure. I think, obviously, without sounding too self-righteous, Yielders, we have created, not only for us was about creating the product and the platform, but for us it was about the financial literacy element of this. Unfortunately, Islamic finance has never quite kept up to traditional finance, even though I think at macro level, specifically in this country, has done wonders. It's never really trickled down to the micro level day-to-day use. And that's something that we really wanted to change. So we've got a fantastic knowledge hub on our platform that will allow you to completely understand our process, but also widely understand real estate investing. We've got a number of blogs that are really well written in terms of understanding what real estate investing looks at a macro level, what Islamic finance looks at in different aspects of it as well. So not without blowing our trumpet too much, we have got a lot of information for people to read and consume. Aside from that, I think there is a lot of information out there, specifically if you're looking at specifics in terms of real estate. We actually use this platform integrated into our financial modeling. It's a platform called Savills. So they provide UK-wide views and understanding of real estate, looking at the macroeconomic conditions, looking at different growth areas in different places, why that is. A fantastic tool. Their website and the platform that they've got is hugely informative. Other accredited platforms such as RICS and CBRE do also provide a lot more detailed understanding of real estate from a development perspective, from a rental perspective, all of these different things. I think those three organizations, I guess we call them, we use specifically, and I would point people in the direction of them. Okay,
amazing. Well, thank you very much for your time today. I appreciate that you're traveling all over the place, scouting out new properties and taking a look there. So thank you so much, guys. If you have any other questions for us, just feel free to drop me a message anywhere, just through info@kestrl.co.uk or through our LinkedIn, YouTube, whatever, and we'll get around to it. Zishan, where can people find you if they want to connect with you?
Ultimately, platform is www.yielders.co.uk. We are on Instagram, handle YieldersUK, LinkedIn, Facebook, all Yielders or yielders.uk. And again, thank you so much to Kestrl. Really appreciate you guys hosting this, and fantastic leaps and bounds you guys have come across with the app, and we're really excited to be a part of that. And inshallah, as I've already suggested, that long strategic relationship, may it continue.
Inshallah, absolutely. And on that note, please do, if you haven't already, please do download Kestrl and check out our investment marketplace. Today was, of course, day 2 in the Halal Investment Roadshow, all about property. Yesterday, we spoke with Simply Ethical about equity investments, where we talked about everything from stocks and shares, funds, active versus passive investing, covering a lot of similar conversations as we had today. Tomorrow is all about alternative investing with a focus on precious metals and gold, offered by our third live partner on the marketplace, Minted. So please do tune in, same time tomorrow. Sorry for the issues. I understand we were live for some people on YouTube. For the rest of you, it started about 15 minutes later. Still getting the hang of this new software. Inshallah, it's going to be sorted tomorrow. For those of you who are looking for screen shares, what we're going to do is we're going to edit this for when it goes out on YouTube, and we'll do screen recordings of Yielders, screen recordings of Kestrl, and interweave them into this recording. So you can check that out, and we'll send that around in our newsletter as well. So thank you so much, everyone, and inshallah, we will see you very soon. Assalamu alaikum.